No two valuers agree on the same valuation. That's the beauty of valuations.
Now Pranav is going to take you on a journey of valuation of unicorns.
As Dipinder Goyal says, there are only good companies and bad companies. A good company is one which can raise money in bad times. And a bad company is one which can't raise money even in good times. Sometimes you have to react with money itself. So, if your competitor is raising $1 billion US, you should be raising at least 1/3. Valuation is not done only on Excel sheets. If you want to know the real value of a company, ask a layman about the company. Ask small restaurant owners and roadside eateries how Zomato and Swiggy have changed their lives. Ask cab drivers how Ola and Uber have changed their lives. Ask street vendors and small shopkeepers how Paytm has changed their lives. As per the Dean, valuations is not a science. Valuations is not an art. Valuations is a craft. A craft is a skill you learn by doing. The more you do it, the better you will get at it. Did you know that there are more than 42,000 CA firms in India? Had it not been for our dean, we both would have been doing taxation and audit related work and wouldn't have really ventured into valuations. People say, Pranav, you are a CA, you should be proud. Yes, I am. But I tell them I am a CA when I am doing audit and tax related work. But I am a valuer when I am doing valuations. While doing valuations, we have to remove the hats of an accountant and we have to don the hat of a valuer. If I were to give you the balance sheet of Zomato in 2010, you would have never ever valued the company at $8 billion US. You have to think like an artist, not an accountant. Get into the heads of the promoters. Think beyond the numbers. Everything we both know about valuations is through real life experiences. We both believe in learning on the job while doing our valuations rather than picking up the book and referring to rules. There is very little theory to valuations. Valuations is based on principles, but sometimes as valuers, we CAs cannot remove the hats of an accountant. Accounting is historical, whereas valuation is futuristic. The dean says when accountants can't understand something, they make a rule out of it. In this new age world of new age companies, value comes primarily from intangible assets, which we cannot see in the balance sheet. For a startup, their team, their founders are everything. Would you value Zomato at $8 billion without Dipinder Goyal? Probably not. KMP is the new valuation. Accounting balance sheets and business balance sheets are two different things. Goodwill is only a plug variable, but has no real value. There is no goodwill in Apple's balance sheet. Goodwill will only show up in the balance sheet when you make an acquisition. Goodwill is not fair value, but book value. There is only one reason for it that it exists in the balance sheet, that balance sheets have to match. Balance sheets have to balance. The only problem with goodwill is that it sounds good, so you feel like paying for it. As valuers, don't get swayed away by fancy terminologies and fancy Excel models. There are n different valuation methods and as many different number of Excel methods. Thank you.